Today we're going to look at a policy and look at an annual statement of an IUL to see, does IUL really work? So we get a lot of questions sometimes of, hey, I want to see a statement or a policy that's been around for a long time and see where it sits now and see what the fees are and see how it's been performing. So let's take a look at a statement and see where we're at with one of these contracts that's been around since 2012. So stay tuned and check out all the videos we have on Does IUL Work under our playlist. Hi, I'm Aaron Andrew, and we're going to take a look at a policy on a female age 54 when she opened it back in 2012. We're now in 2025 at the time of this recording in the summer. Let's take a look at this policy. So looking at my screen here, let's just take a look at this policy and see where we sit. So in this contract, you can see that the policy was opened up in February of 2012. Now, at the time of this recording, we're at the end of July of 2025. So we're in like, what, the 14th year of the policy now. And the client opened this up at age 54, preferred non-tobacco, and they put in money for about 10 years into the contract. They were putting money into the policy. They started out at, $25,000 as example. But right now, they, I think they skipped a few years and caught up. They had a few tough years, which is kind of cool, actually, that you have flexibility. They can stop and stop paying money, and they can catch back up. So there's lots of flexibility, in the contract. So right now, this past year, we had $305,000 in the policy. Okay, we had $27,000 of interest this past year. This is as of February of this year. So the statement was February of 2025. So here we also have cost of insurance that has come out. So let's talk about these fees now. So those fees there of about $2,300 came out for the fees and expenses of the policy, but what is her death benefit? So in this example, she's got $330 in there right now, but let's scroll down and look and see what her death benefit is. So death benefit right now in this contract is $905,000. So that was the death benefit that was required back then. And by the way, I think it's on page like 90 or 98 on the Laser Fund book on the white side of the book we talk a lot about in our videos. I talk about a tax code that changed about 4 or 5 years ago now. One of the last COVID bills, the end of 2020. So January 1st of 2021, one of the law changes where these policies now are 20 to 40% cheaper, these life insurance policies, the IULs, because that law changed and it lets us squeeze down the death benefit even more. But back before those times, our clients that bought policies, they were required to buy more life insurance. So now, the last 4 or 5 years, any policies that are purchased after that date, January 1st of 2021, you can get away with less insurance and have lower fees, expenses, commissions. It's pretty cool. So in this example, though, she had to buy $900,000 of insurance back then, and she wanted it actually for their family and for her spouse and for their kids and so forth. So $900,000 was the death benefit amount. So right now, today, though, is she paying for $900,000 of insurance? No. All right. If she passes away, what does the family get? Let's go back up here and look at the cash value. Okay, so she's currently got $330,000 in there. So her death benefit was $905 minus the $330. We're at $575 is the difference. So again, death benefit was $905. That's the total amount that her family gets if she passes away. That includes the cash value. So that's why I'm teaching you right now that we got to subtract the difference to show you the net amount at risk. So she's got $330 now of cash value. So the difference between those two is $575. That is the net amount at risk, okay? So what we're talking, why I mentioned that is that's what they're charging her for right now. So she is now, let's see here, she's 54, and we're about almost 14 years into this now. So she's 68 years old now. So for that much insurance, for $575,000 of insurance, they're charging her $2,000, $2,200. Now, I just talked to her on her annual review a few months ago when we met. I talked to her about, hey, do you want to drop the death benefit? If she wants to, she can drop that death benefit now because we're past certain tax code timeframes in this after 11 years in these older contracts, that we could drop the death benefit and lower the insurance. So she could do that if she wants to, but doesn't have to. So in this example, she's kept her death benefit up there. She has kept it higher to have that insurance for the family. So every year we meet, I just throw it out there and say, hey, everything looks great. We're earning good returns. We earned $27,000 of interest this last year on your $305,000. that helped cover the cost of insurance, and we have $330. So it's really cool with IUL, you guys, that everything is full disclosure. She had 305. She had that much go in interest, 27,000. She had 2,200 come out in fees and the $90, and that equals 330. It's all laid out. Okay. The problem with whole life that I have a problem with is whole life is great in some ways, for certain reasons, but I like IUL much better because it's full disclosure. Whole life, you don't know anything going on behind the scenes. You don't know what your fees are. They don't disclose it, and they never will. And so basically IUL, full disclosure on what your fees are and on the illustration going forward. You know what your fees are going to be. Pretty cool. All right. Now the returns, and that's what's different, is IUL, you can earn much higher returns. We can't have zero some years, but we have really good solid returns with the indexing features. And let's see what she earned this past year. So this past year in the accounts that she was in, she earned a little bit in this account. She earned 7.65 in this account. She had some money in this account and earned 10% in the S&P. Okay, so 7%, 10%, 9% in this one. And then she had some money in this one and earned 9.5 in that one. So you can see she could have earned 16 in this one and 14. We weren't in those. Those are a little bit more aggressive accounts. She could have been in those if she wanted to. And this is where you could reallocate every year where your money is kind of invested and so forth. So those are kind of the returns she earned. Good, solid returns. 7.5, 10, 9, 9.5. So that's why you can see up there she earned almost around 10%. Well, let's just do the average there. 27, 499 divided into 305. 556, yeah, 8.99. So she earned an average of 8.99%. And then she had, these costs come out of the policy, and she's got 330 in there. So she hasn't needed this. You can see she doesn't have any loan balance. So she hasn't taken any money out. We talk about it every year. Do you need any money? Do you need any money? You can take money out of this if you want. Do you want to lower the death benefit and lower fees? Now let's take a look at an in-force illustration to show what this would look like going forward if she decided to take out some loans. Tax-free loans, by the way. So we go to the other chart here, and this is what we call an in-force illustration. So you can see we're in the 14th year of the policy, and right now, if we want, in this 14th year of the contract, we could start to take out what we call index loans, where we borrow at 5% while the money is still in the account. Her collateral, the money in the policy, stays in there, continuing to earn the index returns. So those higher returns we just earned, about 9% this past year on average between the different accounts. She can keep earning the 9% and borrow against it at 5%. Some years we're going to earn 0. Other years we're going to earn higher than the 8 or 9 in some of those accounts. But on average, if we earn 6, 7, 8, 9, 10% and borrow at 5%, we're making what we call a spread or an arbitrage. If you want to be conservative, you can borrow on the fixed loans where you borrow at 2% and then the collateral earns 2. It's called a zero wash loan. You have that option in the policy. So in this example, we can take out 21,000. Again, very conservative projection, but you can see if we drop the death benefit. So again, her death benefit was up there at 900,000. The reason it's 883 because minus the loan, if we take a loan of 21,000 that year. But you can see the next year, if we drop the death benefit, this is really cool to see this actually, to understand it. You can see that the fees go from there and they go down to $300 to $400. Why are the fees so much lower? Because we dropped the death benefit as low as we could by law to have it be close. So like right there, year 19, age 73. The difference between 300,000 and 356, that difference there of about 50 grand, that's only costing us $455 at age 73. All right. So we can get the cost down if you want by dropping the death benefit in some of these and lowering the cost. Okay. But in this example, we're taking out 21,000 a year, not paying any loan interest, just letting it grow on the loan balance here. So if she passed away at age 90, for example, we would have 200,000 left, but your family would get 260. So again, that year, let's look at the fees now. So that year, that's where the fees kind of peak at age 90, 91. The fees are $3 grand. Why? Well, the difference between 200 grand and 260, let me scroll up so you guys can see that. That difference there of about $58,000, that's costing us $3 grand in insurance charges at age 90 because, yeah, you're older. The likelihood of you dying is high. You get down here at age 96, under the tax code, the cash value and the death benefit are allowed to be the same. So that's why there's no more fees. Okay, so under the tax code, there has to be some insurance risk there to have this still be classified as life insurance to be tax-free. But all this money is coming out tax-free, $21,000 a year. This is a very conservative projection. It could be more, it could be less. But this is projecting forward. If we earn an average conservative return, we could take out $21,000 a year, projecting out the fees and the expenses. It's called an in-force illustration. So if you have a current IUL, you can ask the company for one of these. And you don't need to do it if you're only a few years into it. Just look at your normal illustration as long as you're on track with your payments. But you can look at an in-force illustration after you've been in it a while and say, what does this project, going forward? What does it look like? So it's pretty cool. Now, again, is it going to act just like this? No, we don't know. Because again, things could change. Returns could be, could be up or down a little bit. But this is a very good conservative projection of what it could look like if she wants to, in this 14th year, start to take out $21,000 a year tax-free. And we could drain it faster. She could drain it to age 80 or 85, but we wanted to last it to age 100. So we took out, we solved in the software to say how much could we take out if we wanted to take this out until age 100. Okay, so pretty cool. So there's an example of a policy that's 14 years in, looks great, got low cost. We still got a high death benefit because they want it, but they can lower it down and lower the fees. You can see they earned about 9% this past year, did great in their returns, tax-free. And this is, so does IUL work? Yes, you can see in these examples where a policy's been, where it's at now, and what it looks like going forward. So stay tuned and make sure you go to our playlist under the channel, and you can see more on those videos, Does IUL Work series, and we'll keep adding more and more of these where you can watch other policies and other videos and look at policies that have been around for a while. And then also make sure you go to laserfund.com, get a free copy of the Laser Fund book, read chapters, read the white section first to get the numbers, the details. Call us up and we can design a policy for you to show you what this could look like for your situation to generate some tax-free income. Thank you so much for watching.